we're going to talk about the difference between SPY and Qs, because here's the thing. Most people don't, or maybe not most people, but some people may not be aware. But the Qs also have the 0 DT options listed every single day. So they have daily expirations, just like the S&P 500 products. Now, we've only done studies in the S&P 500 SPY over the last few weeks with these 0 DT options. But the thing is, the Qs have them as well. And this, I thought, would be a fantastic time to compare the same type of moves. Like if you were trying to scalp these, and we're going to do these from the long side, this is more applicable to the long side, but really it goes for every single strategy. If you have the Qs, which usually are more rich, right, higher implied volatility than the SPY, well, what's the difference when you trade these 0 days options in the higher IV underlying? And the cool thing is SPY and Q are highly correlated. So on days, you could get the same down move in the SPY, you're going to have the same down move in the Qs. What are the differences between those options in the 0 day cycle, given that the Qs are richer to begin with? Mm-hmm. And I think we have never done that. And I think when you apply the same type of logic, to longer expiration options, like, you do Tesla versus the euro in like the 45 days. Well, we know you're going to sell more credit in Tesla. It's going to be a higher risk underlying. But how does that translate to the 0 day options, right? That's the question.
Cool.
All right, let's see.
So right now, and Beth, we'll go back one slide. I just wanted to point this out. Right now, these data I pulled just this morning, right? So right now, the IV and the Qs is about 3 points higher than the SPYs for the 0 day options, right? That obviously will translate to a higher premium put. Now, obviously, the SPY will have a higher credit because it's a much higher priced underlying.
Yeah.
But when you adjust for the implied volatility, the Qs have more premium, about 3 points extra, because the IV is 3 points higher. Funny enough, these all have some put skew today in the 0 day options for some reason, but I think that's pretty understandable. Okay.
Yeah, and you're generally going to see the Qs with higher volatility. I mean, the NASDAQ has generally higher volatility. The NASDAQ and the Russell usually are the highest volatility of the 4 indices, of SPY and the Qs, or SPY and diamonds being the lower end of the volatility. So it's typical that you would see the Qs implied volatility higher than SPY.
Exactly. Mm-hmm. So let's go to the next slide. And what we're going to really ask today is, okay, on the day where SPY and the Qs retain their correlation. So here's the key. We're going to intentionally cherry pick some days where there was a huge down move in the SPYs and the Qs, both roughly the same magnitude, okay? Mm-hmm. Very similar price action. The reason we're doing that is because as traders, whenever we see a down move in the markets, right, we usually always compare to, okay, well, if the SPY is down, what are the Qs doing? What is the Russell doing? What's gold doing, right? We always try to compare to other assets. And especially when we're trading these 0 day options, we want to say, okay, if the SPY is down 1% and the Qs are down 1%, what's the difference in those option prices? What's the difference in those returns? Because we know that the Qs had higher volatility to begin with. So there has to be some difference. And today we're going to look at exactly that. So I think the results are going to be very interesting. Now, the question is, which 0 DT options have been more expensive? That's probably self-explanatory. Usually, almost always going to be the Qs. And when you have a move that exceeds the expected move, what happened to those options? Now, we're not going to look at butterfly strategies where nothing happens, because obviously you're going to get a full profit on both the SPYs and the Qs, right? It doesn't really matter. If you do basically play outside the expected move plays, or you can be short the options too, right? You just take the opposite sign. What is the difference in returns in those options when you have a move that exceeds the expected move on both?
Cool.
Okay.
All right, let's take a look. We're going to look at SPYs and Qs compared to 25 delta and at the money 0 DT puts. We're going to look at down days. You could look at up days. It's going to be very similar, just flipped, right? Remember, you could do so many different things with these. So we want to standardize as much as possible to look at one specific takeaway, right? Because when you start adding stuff, it gets too confusing. So on the days where the SPY and the Q were both down 1%, 2%, and 3% from the trade price intraday. So we're just going to say, okay, we put an option on. We saw 1% move, we take it off. What's the return? 2% move, okay, what's the return? What's the return for a 3% move, right? So we're going to compare the percentage return on the initial option price and the initial implied volatilities of the options. So we're going to look at how much more expensive were those options when you put the trade on, and then when you had the move, which options moved more and by how much.
Okay.
Okay.
Cherry picking, looking at, the hardest thing to time ever is, these sort of moves. You're talking about 1, 2, and basically 3 standard deviation moves here, if you were able to time it.
Exactly. Now, I do want to mention something before we go into the results. Cherry picking in research does not necessarily mean it's bad research. The point is to say, what's the point of the research? And the point here is not to say, okay, if you cherry pick the 3% move, you got a 900% return. Well, okay, great. It doesn't matter, right? Because we don't know where the 3% move is coming. The point is to show, if we do have a 3% move, what's the difference in the Qs and the SPYs? What's the difference in those 25 delta and the 50 delta puts, right? We're comparing the numbers as opposed to looking at the raw numbers themselves and saying, oh, wow, 600% move. Well, okay, but we're not looking at that specifically. We're comparing the moves to the SPYs and the Qs, okay? So that's what I want to focus on.
It answers the question, and I get this question all the time, is like, okay, I think, tomorrow or next week or something, there's going to be a market crash. What is the best way and the most profitable way to play that sort of event, right? You're talking about a fraction of a percentage probability of happening, but you have a hunch, you want to play it. This answers the question of what your expectations should be of, the potential profitability, and it'll give you the best way to do that. Here's the way that you can play the tail. It doesn't take away from the fact that it's still a very, very low probability of happening, but if you're playing it, here's how you can do it.
Exactly. And listen, if you're playing the options, as more of these 0-day options come to other underlyings, you're going to see a much bigger IV difference between SPY and Tesla, let's say, or Bitcoin, let's say, right? So if you're going to play for a down move, you got to know what you're paying for, because they are very different. And, this is a good starting example because we have data for both. So ready for the results. All right.
Ready for the results, yeah.
Drum roll.
So for 25 delta, so we're going to look at 25 delta and 50 delta puts. The results are going to be kind of similar, but some subtle differences. Just wanted to get the whole spectrum here. For 25 delta puts, the first thing I want to show you, the IV in the Qs was around 22% higher than it was in SPY. So Qs had IV about 33. The SPYs 0-day options had IV about 27. So right off the bat, you're seeing you're paying, and what all that means is you're paying 22% more for that same premium, price adjusted, than the SPYs. Well, what does that mean if you have the same percentage move? Well, here's the thing. If you have the same, because we're comparing the same 1%, 2%, 3% moves, the SPY had a significantly greater return on those options because the IV was less, but we're comparing the same percentage move. This is one of the biggest differences when you talk about IV. If you're playing it to the long side, right, or you're playing to the short side, doesn't matter. If there is a move that you compare, the same move, with low IV stock, high IV stock, those lower IV options will be significantly more sensitive to that same percentage move than the high IV options will. Why? Because you're paying more for the high IV options because the move is more likely. So if you look at it down the line, right, SPY for a down 1% move, the 25 delta puts, up 176%, for the Qs only 150. For the down 2%, 440%, only 251 for SPY, right, and so forth. You can see on the right, the most right-hand side, that the percentage difference between those moves is approximately between 20 and 75% greater for SPY for the same percentage move. Okay? But you're paying 22% more. So what does that mean? It means if you don't get those moves, you're going to lose more on the Qs options. You're going to lose 22% more on the same one lot, volatility adjusted price adjusted on the Qs than you will SPY. You're paying more, but your payoff is greater if you get the move, right? Now, here's the cool part. When you're down 1%, now remember, expected move, if you look at it between SPYs and Qs on a single day when volatility is about this much, is about 1.5%, approximately. That's the expected move, okay? Here's the really cool kicker that you don't really get unless you dig into this. What's the IV difference? About 22%, right? If you're down 1%, how much more do you make on the SPYs? About 17%. the expected move is about 1.5%. So at around 1.5%,
It's basically
you see
the same.
IV cost premium be the same as the outperformance in the lower IV in the lower IV options. It works.
So you're saying the options are perfectly priced, really what you're saying.
Exactly. You're paying more, and if you get the expected move, you're going to make exactly more how much you paid. It's a risk-reward linearity. It's the same trade, if you can call it, except you're just paying a little bit more for the Qs. But it's the same thing as if you had bought 1.2 SPY options. If you could do that, it'd be the same.
It makes perfect sense. And you can take it a step further and just to correlate this to like, you know, how we generally trade with short premium and around 30 or 40 days till expiration. If you consider that these are the similar or the same underlying, right? You can see the higher volatility underlying, if volatility is realized, is going to be less of a loss if you're selling that premium versus something that's very low volatility or lower volatility where it realizes that tail sort of event. And this is, you know, it comes full circle in the sense that, you know, if you were considering this as a 30 or 40 day option, which one would you rather sell? You'd rather sell the Qs because you have less of a drawdown. It's the same thing here of, you know, if you think a tail type event, not something that's not priced in, you want the lower volatility underlying because those options are going to be much more volatile because they are priced in to no volatility. If that makes sense. And when you're trying to fade the expectation of volatility, you want something that's as high as volatility as possible, and that would, in this circumstance, be the NASDAQ.
Exactly. So now here's the cool thing as well. As you get into the down 2%, down 3%, now those are well beyond the expected move for both the NASDAQ and the SPY. So of course, you're going to have the SPY difference compared to the NASDAQ be significantly greater, right? Because now you're taking a low volatility option and now you're giving it a 2, 3, 4 times the expected move, right? And now, of course, you're going to see significant outperformance because, well, the Qs, you had a richer premium to begin with, right? But for those 1 to 2 expected move or 1 to 2 standard deviation moves, you're going to see the premium be priced around the same as the outperformance that you got in the lower IV underlying, right? So it's an interesting way to look at it because as you get more of these options, you're going to have to know what the difference is between something with an IV of 50 versus something with an IV of 25. And the difference is you pay more, which means you're expected to move more. And if you move less, you're going to lose more. But if you move more, you're likely to move more. So that's why it's priced in, right? So it's all about that risk-reward balance that's being realized.
Beautiful.
So, all right, let's go to the next slide. We're going to take a look at the 50 delta puts quickly here. So notice the 50 delta puts, right? There's a big difference between this and the 25 delta. So first of all, for the 1 standard deviation move, which is about 1.2, 1.5%, you see the percentage differences between the options be close to the difference in IVs, right? We just talked about that. 24% difference in IV, about 27% difference in the actual realized move for the options when you see it. Now, here's the difference. 50 delta puts are already closer to the money. So what do you see? You see less of a tail impact. So if you notice the down 2%, down 3%, those 50 delta puts are only about a 50% difference between SPYs and Qs. If you go back to the 25 delta puts, you see closer to 75% difference. And that's only because, again, further out of the money for a low volatility underlying means you're going to have a huge win if you get that move. But if you have a 50 delta put, you're going to get a win, but it's going to be more expected, so the differences are going to be less. And so everything we talk about in our research from the 45-day options plays exactly the same. The difference is that this happens on a daily basis, so it looks different when you put the trade on, but the mathematics work the same way.
That's the volatility smile, Anton. Those at-the-money options, those 50 delta options, this move, you probably make more dollars on this move down because you have a heavier delta option. But from a percentage standpoint, the tail options are going to explode in value, and that's why you're seeing on the first slide that you're making a higher percentage on those options. But the volatility of your P&L is 0 or 100, whereas this one is more, flat, so to speak.
Right. And again, the key in this study is really to look at that difference column, that percent diff column, the last one on the right. Because remember, the actual percentages by themselves, like down 2%, you make 277% in the SPY, 50 delta puts. Okay, great. But the point is to say, okay, what's the difference between that and the Qs, which have a higher volatility? That is reflected in that last column. So when you look at that last column, you want to compare, okay, how much is the IV difference versus when you have a down 1% move, which is roughly the same as when it's standard deviation. They're around the same. That's a huge takeaway. That means they're priced perfectly. And now you look at what's the difference when you get the tail moves, right? And then you see, okay, it's bigger difference because lower volatility options, tail move means bigger explosion in price, right? So there's a ton of stuff despite the seemingly simple study, a lot of takeaways that I think are very applicable to people trading these.
Good job.
All right,
take us home.
Slide 6. All right. So for the Qs, 0DT options have been roughly 20 to 25% more expensive than SPY on average. Okay. Obviously, right now the difference is a little bit smaller because IVs are down across the board. The same percentage move between two underlyings will cause a higher percentage move in the lower IV options. So if you're saying, I think there's going to be a 1% drop in the market, and you think that the difference in NASDAQ and SPY isn't going to be great, isn't going to be all that big, you're going to want to trade the lower IV options, right? It seems kind of simple, but when you put the math around it, it brings it home. And finally, the difference in the percentage returns of the options are similar to the percent difference in the option IVs. When you have that one standard deviation move, that basically shows that, okay, IV price is one expected move. If you get one expected move, what's the difference in the actual returns? And they're basically the same as the difference in the implied volatilities, which means that risk equals reward. Obviously, any bigger move than that, you're going to get paid. Any smaller move than that, and you're going to lose on those higher IV options if you're long them. So,
I like it. Next time you got to add beta in there, and totally match them to each other. Because if you take beta into account, you consider that the NASDAQ is usually more volatile than the SPY. Then is there a difference? That'll be
exactly. Yeah, this is. I mean, you could take this 10 different ways. And
sure.
Maybe we'll do a series.
I'm going to ask you to put it on your radar. Tom made a comment today when we were in Confirm and Send, when people say like what option to sell, and we were really talking about shorter dated options, zero dated options. Maybe you can compare 0 versus 1 day if you have the data on that. He was saying to go just outside the expected move and sell those options. I would like to see you, from a strangle standpoint of view, compare 0 day to 1 day. Not like if it's a great strategy to do, but if there's any edge between that extra time value of a day, you'll probably be able to go a strike out. I'm assuming that, let's say you've got a $2 expected move in 0 day, you have a $3 expected move in 1 day, you'll be able to go a strike out if that extra time is worth anything, either closing it the next day or taking it to expiration. Do you know what I'm trying to say? Yeah,
you're kind of comparing calendars. Like it's the same thing as looking at calendars in a sense, but splitting the 0 and the 1 day.
Putting the wings together. Yeah, you're 100% correct. How you got to do it on the back end is your business. But I would like to see that, because that's a statement he's made a couple of times, and let's see if it has any weight. Sound good to you?
Sounds good to me.
Awesome. Thank you, Anton. Appreciate it. We're gonna take a quick 90-second break. We'll come back. We're gonna bring joy, Nick. You're gonna love this. You'll be able to be on the show from the very beginning with my friend, Mr. Scott Sheridan.
Beautiful.
At Tasty Trade World Headquarters. We'll be back in 90 seconds.